Hi, my name is Jim Rector, and I am the asset manager for Ethos IRR.
Hi, I'm Mike Reyna, managing member of Ethos IRR.
Hi, I'm Brent Conlin, managing partner with Espada Real Estate.
All right, welcome back. This is our second episode for Ethos IRR. Brief recap from our first episode. Obviously, we wanted to talk about our mission statement, our core values, and our approach and opportunity. I mean, our investor-first philosophy is really what matters to us. I mean, we spend a great deal of time and effort to think about and make sure that your money gets treated better than our money. And we like to do that on every deal. We've got Mr. Brent Conlin as our first guest. And Brent, why don't you tell us a little bit about your background and how you became a real estate developer? I know the story, but I think you have a great story.
Yeah, it's long, so I won't bore you with a full 30-year history of practicing commercial real estate. But started off going to graduate school, land and real estate development focus, and got my first job with Argus Financial Software, which is kind of an industry-leading lease analysis underwriting program. From there, segued into working with a Trammell Crow company here in San Antonio. Had a great mentor, a guy by the name of Bob Barnes, both of you know. No longer with us, but a great man.
Great guy.
He was.
Did some really cool things, really working more in a brokerage role at the company as I started. Progressed from being a retail broker to an investment sales broker. And then in early 2000s, when Bob and a couple of the local Trammell Crow partners left after the company went public, it opened up a door for me to try and fill some semblance of his shoes in the development role. So I stayed with the company another 8 years in that position, that capacity, and learned the development game with the Trammell Crow company. And then in 2012, started the private development arm of Riata Real Estate here in San Antonio, which was the company that Bob and the other Trammell Crow partners had left and started back in 2001 as a brokerage and property management company primarily, with Bob doing some development when he felt the need along the way. So, a great opportunity to work in a great organization. Can't say enough good things. I think Trammell Crow CV is a company, and the number of people that they've put into this industry that have been by any account successful is about as strong a testament as you can have for the program, yes. the way that Mr. Crow started developing with partners, and what a great training ground it was for sure.
Yeah, absolutely. Yeah. I mean, it's produced a lot of people in our field.
Yeah. So fast forward 2019, now 5 years ago, last month actually, celebrated our 5-year anniversary of having sold our brokerage and management company to CBRE, which full circle, funny story. CBRE ended up buying Trammell Crow Company right before I left. So second go round of selling to selling to CBRE in some capacity. We kept our portfolio of assets and our development arm operations private. Was not a candidate for something to be purchased by CBRE, and have rebranded that Espada Real Estate in November of 2019. It's been a quiet 5 years in the development sector. You know, we tried in early 2020 to pull together some projects that were entitled and permitted for in 2019. Costs immediately went through the roof. It became next to impossible.
Yes.
And really just have reverted more to acquisition and operate really today, just given market circumstances, not from a lack of desire to develop new product, but more as a private equity placement and acquisition. So a lot of the conversations that we've had over the last year or so, as you guys have been putting Ethos IRR together, are opportunities where we're looking for like-minded money capital partners that come in and allow us to do what we do, creating value. And I think we've got a pretty good story, as we've discussed, of how we operate and how you guys focus with your core values and company ethos, as it were, to take care of your investors' capital.
How did you come up with the name?
Espada?
Yeah.
Gosh, I wish I had a really exciting story. We were becoming increasingly more drawn away because of opportunities to acquire assets outside of San Antonio, really to some degree outside of Texas. And we didn't want to lose the connection to San Antonio.
Oh, cool.
So we started talking about the missions, and obviously the Alamo is greatly overutilized. And we weren't looking for top of the yellow pages type reference, the way things work today. And Mission Espada really spoke to us, being the oldest mission.
I thought it was that.
And then the translation of Espada, as we learned, is sword. So our logo is an E with the central piece of it is actually a sword going
right.
there.
That's true.
It's kind of a cute little logo, but a nice tie back to San Antonio.
That's neat. That's neat.
That's a good story.
That
is a good story.
Absolutely.
It was well intended, that's for sure.
One of the things we want to highlight here is we want to try to demystify what a developer does. As a real estate developer, you're somebody I've known for a long time, and we talk about from Ethos's perspective, we're really looking for people that we trust. We're looking for people that we know how they act under duress. I mean, that's my barometer of, is it somebody we want to deal with on a level of providing money for sponsors or developers, however you want to say that. So we're looking for those people that have done well through a number of cycles, obviously, in the real estate, but also that we get along with. Our values are the same, and that's difficult to do. And you're one of those people. So it was easy to have you as our first guest. So again, thank you for doing that.
Thank you. Multiple compliments in there. So I'll take them as such. Yeah.
But I do want to talk. I want you to kind of help demystify, what does a real estate developer do? I mean, we're providing capital. Mm-hmm. So we're providing equity usually with you guys. You guys are not looking for debt. You're looking for equity. And we're not really providing debt at any place. We're more equity. And, what is it you do? How does that work?
Good question. My kids don't really understand it either. And they're old now.
Here we go.
So I'll coin a phrase that Bob, whom I referenced as my mentor earlier, used to say. And it's like, a developer really doesn't possess a skill other than managing the talents of others. And the phrase that Bob really, or analogy Bob came up with is, or used to say all the time, it was like being the
orchestra leader,
conductor of an orchestra. Oh, exactly. Yeah. He said, you don't really play an instrument. You don't write the music. Certainly not acting or doing anything else that's contributing to the show. But without that coordination and someone driving the bus, the whole thing kind of falls apart, theoretically, right? So as a developer, I think what that really translates to is we are managing the talents of others. Mm-hmm. We're taking ideas. Sometimes that's driven by a user demand. They need something in a market, and we are there to help them figure out where that needs to be. That usually brings in orchestrating the talents and knowledge of a really good broker. Or someone who has great market knowledge and connectivity to what's happening on the ground. Very quickly get involved with a civil engineer who's highly trained and theoretically possesses a lot of knowledge about how things work and how we tie into public utilities and get entitlements in place to be able to do what we want to do on said piece of property. Ultimately, an architect comes along and designs a structure which becomes the income-producing asset that we ultimately want to own and operate. As that process is going through, we're working with attorneys and all kinds of other consultants, environmental engineers, sometimes wetlands, other people who are highly trained in their fields that are contributing actual skill sets and knowledge to the orchestra of what we're trying to create. And that ultimately, at the end, is an asset which creates an income stream that is financeable and is investment worthy. Once we actually get it constructed, so there's a construction team. In order to get that thing constructed, we have to have lenders and equity. So we're managing the capital stack, which I think we'll probably talk about in a little while. And then as that process plays out, we actually deliver the building. The work is not really done as the general partner. Maybe we're not developing in the context of building something new at that point. It's built, it's operating, it's occupied, it's generating an income stream, but you still have to manage that asset. It needs maintenance. The property taxes need to be paid. Vendors need to be hired to manage the operations of the building. Sometimes that means actually contracting and paying for those things. Sometimes it's just making sure that they get taken care of. So you bring in people like property managers and they're coordinating things with tenants. Inevitably, attorneys are continually involved throughout the entire process, which is why my son's in law school. Hopefully we get him on the payroll sooner than later. A little sidebar. The reality is that the lifeblood of the asset and managing all of these very highly skilled and trained people to contribute to the big picture, that really is the role of the developer.
How do you get, we in the business call it a pipeline. How do you look at a deal? What interests you? What criteria do you have for doing that? How does that work for you guys?
And that's an interesting question, because struggle is too strong a word, but we're debating at what point do we stick our toe back in the water of actually developing new product right now. I think our team and a lot of people like us have taken the better part of the last 24 months on the sidelines and just said, you know what, now is not the time to develop. Costs of capital are high. Construction costs are really still elevated post-pandemic. We're not seeing the relief. We are seeing vacancy rates. And everything I say is going to have a little bit of a skew towards retail, because that's 90% of what we do.
Absolutely.
But I think this is relatively true across all sectors of our industry. Construction costs are high. Costs of capital are high, as I've stated. Rents are starting to come up. We're not quite at that point where the cost and the income stream are going to throw off the yields that are needed, but we're getting much closer. And I think one important thing worth noting here is what I've learned the last couple of years that I didn't learn in the first 28 years of my career is that our industry works really, really well so long as we all agree which general direction the market is headed, right? So if we think values are going up and opportunity is going up and growth is happening, then things happen.
True.
If we feel like it's going down, things still happen. The transactional volume stays relatively static, and there's some prediction about when to buy in or when to sell. It's even if it's flat, we all agree it's flat, that's fine too. Right. When there's uncertainty about which direction things are going, capital doesn't agree with construction, and the tenants aren't really sure about what's happening in their sectors, and everybody feels like these things should have an impact on value, then nothing happens. Right. And that's kind of where we've been the last couple of years, in my opinion. I think a lot of people would agree.
No, I agree. Yeah. What about, do you think, so the last 24 months have been kind of like everybody. We've been in a foxhole, right? So now we're peeking up, looking up in the sky saying, okay, is it all clear? So just in your opinion, what do you think, I know we close out 2024 and we're looking at 2025. What's your crystal ball say?
As we were just discussing a moment ago about agreement amongst everybody in the industry, all the players. I think we're finally all in agreement now. It's a secondary debate as to whether we all agree that just because interest rates are going lower, the market's going to get better or not. I think it's a little deeper than that. But I do think, generally speaking, the market is trending in the right direction. And we're starting to see things loosen up. If you look at transactional value this fourth quarter of 24, I think the people in the title business will tell you things are actually trading. We're establishing new comps for where values need to be in order to transact. We're seeing an environment start to loosen up with lenders where capital is now available. I think it's errant for us to believe that SOFR, which is the index which we live and breathe by for debt, is going to trend dollar for dollar, point for point rather, with the Fed decreases. I think we'll see some diminishment in the cost of our capital, but there's so much pent-up demand for it. I've had several conversations with bankers just to say, is it realistic that you'll let that capital go to the first come, first serve? And the answer is quite simply no. Sponsorship will still be priority. Quality of the project, obviously, always important. But there's going to be so much demand for that capital that the pricing from the banks, if nothing else, will eat up some of that margin. Can forecast all day long. Do we see 5% money next year? Probably not. 5.5%? Good chance, I think. And I think over 25, 26, we'll start to see that get closer to 5. Maybe we bottom out as low as 4.5. But the days of 4% money and some of those other really aggressive lending terms are probably going for a while.
That's not realistic.
No, and then hopefully costs will come down.
Rents will keep going up.
Exactly. Perfect world. Hopefully
that's what we're looking for.
That's what we're looking for.
Well,
Can you promise that?
We've all been through a couple of cycles, right?
No. Look at our faces, man. Gray hair, wrinkles.
It's a different set of variables, perhaps, but same cycle nonetheless. And we are definitely at the precipice of a great time to buy into the market. And leading into what do I see for 2025, I don't see us pulling away too drastically from the acquisition component of our business model. I think we're going to more aggressively be looking for development opportunities, and those are likely going to be end user driven, where we can pre-negotiate that margin, that profitability in the deal, with costs in tow. But I think the acquisition, that now is the time to buy. The only proposition that's made any sense to us over the last 24 months is if I can go buy something at $150 or even $200 a foot, and my replacement cost is $300,
right.
well, then I've got a long-term proposition there. I can operate, I can push rents, I can mitigate some of the operational through our property management division we have in-house, and pick up some efficiencies and profitability in there. Nothing wrong with owning an asset at $150 a foot basis,
right.
going into a really tight market that you have for long-term hold and can allow rents to kind of catch up. Building something at $300 a foot or $350 a foot, as it were, in some cases, is still tough. Because not only do you have to compete with the vacancy in the market of that guy that's got the $150 foot basis, but you've got to go out there and really be the pioneer, breaking that glass ceiling of where rents can go. And San Antonio, of all the Texas markets, has always had the thicker glass ceiling, maybe second only to the Rio Grande Valley. I mean, the rent ceiling down there is definitely more opaque than it is here. But,
we're not Houston and Dallas.
We are not Houston and Dallas.
So you feel more confident about pulling the trigger on deals?
I do. And I think it's going to come down to the underwriting. What is the proposition? Where can you get that tenant or tenants to go with rent?
Right.
Because you've got to manufacture that yield somehow. And doing it with debt has not been, really a possibility.
Yeah. As a developer, it's almost like playing blackjack.
A little bit,
right?
A little
What's
bit
on the table?
Yeah, more like craps, maybe.
Craps?
Yeah, there's a few side bets that really you can make your margin with. But the opportunity to go manufacture yield through leverage has been a real challenge, if not impossible.
True.
Which is why a lot of us have taken a step back. It's like if we're going to get an 8% cash yield to our capital. And our debt is going to cost us 7 or 8%. There's no arbitrage there where we're getting any percent. Even if you delever down to 50%,
it's still not
there's nothing there to really work with to manufacture that extra margin. So equity's been taking it on the chin. You can come into deals. You can get your allocation of tangible assets and real estate in your alternate investment category. But your yields are lower, and in a lot of times, when you're comparing a 6 or even a 7% yield, risk adjusted to 5% in a 6-month CD or T-bills, I was like, the risk proposition has not been there. But some people are just hell bent, I got to have it, and we certainly cater to that too. So.
Right.
When in your underwriting, I mean, we want to collaborate with developers in as you are underwriting, and obviously we've got Troy who does a great deal of our financial stuff and going through and trying to vet deals and look at deals. And we don't mind, looking at deals early and realizing that we're going to kiss a lot of frogs, so to speak. And I would rather do that than not be in the middle of deal flow. So don't ever hesitate to call us about, hey, this is it, no matter how preliminary.
A lot of tadpoles I'll send you.
Exactly. That's all we've got right now, so that's what we're willing to look at.
Yeah, I'm doing the same thing for what it's worth. I look at whether it be an acquisition, not as many true ground-up development deals, but a lot of reposition, value add, or land that's entitled that's maybe ready for smaller scale development. Looking at a lot of those things, multiple deals a week, oftentimes, and it's just 1 out of every 10. Arbitrarily has got enough traction to really talk about amongst our group.
It's crazy.
Yeah. What are some of the financial challenges you see? I mean, I'm looking at how does Ethos fit with you in development, but I mean, what kind of challenges are you seeing, and how could we as Ethos or anybody that's providing equity
to your group
really provide more value than what you see?
So a lot of what we have experienced with our equity sources and quite frankly, our own money, I mean, we're largely our own equity source. Some of the larger stabilized assets that we've acquired over the last 5 or 6 years have been a compilation of a lot of external equity that we're pooling together. In fact, we played around with the fund model ourselves, and it just started to feel like too much of a departure from our own business model. And the market wasn't really in 2021 when we talked about doing this, wasn't really responding with the opportunities that we anticipated. We thought people were going to run from retail after the pandemic. It's like, I don't want to own this. It's a lot riskier than I ever thought. And it just didn't happen. Matter of fact, if anything, retail became kind of the darling, particularly once interest rates started going up and office buildings and multifamilies who were operating at very, very thin margins realized that there was an end to the road, right?
That's true.
So we just didn't see that materialize and very quickly stepped away. It's like, let's just focus on what we do, and that's identifying opportunities where we can create value and own 5, 7, 10-year holds, create real value, and then exit, repatriate, redeploy.
Okay.
Is kind of our general model. Again, not earth shattering. Most people do the same thing. I think where we have found equity to be true partners is the people that look at a deal with the same timeline objective as us. And it's hard because
Sure.
equity has a lot of different things pulling to get its attention. And you don't want to be in a deal for 5 or 7 or 10 years if there's a short-term repatriation play, the market's changing. It's like, I just need something stable to get me a decent yield for 2 or 3 years, and then I want to take it back out and put it back in and make 3 decks.
Yeah.
If we could predict when those things happen, we'd all be not doing this probably.
I'll tell
we
you,
wouldn't.
give me a 3X.
We'd be doing this from Cap for Odd.
Yeah, we wouldn't be doing it here.
The reality is that finding equity that is willing to ride the life cycle of the asset.
Yeah.
And again, for us, that's 5 to 10 years. We tend to hover in the 5 to 7, and we're usually looking by year 5, even if it was a projected 7. We're looking, okay, well, what is the market telling us? Or is it time to maybe get out now?
Well, we're not any different. I mean, we look at that, and I think we have 5 to 7 year horizons as well.
Correct.
And and I think we have the ability to extend a little bit. And obviously, there's deals that take more time. It takes a little more time than you think.
I mean, obviously on the development time, because you probably, as you know, I mean, it takes what, a year before you buy the dirt, and then by the time you go ground up, it's usually a year, right?
And then deliver, and then tenants have got to work out. I mean, it can be 2 years where you really start
by the
cash
time we start seeing returns, you're 3 years, 4 years into the deal.
So equity investors who understand the process, again, huge check mark, love it. Desire to allocate capital on some kind of regular basis, in the queue for the next deal.
Yes.
We love people that want to take that partnering approach. Like, hey, you guarantee us a spot in your deals, we'll guarantee you a source of capital. Yeah. Those are fantastic. Obviously, all of the credentialing of being accredited and, going through the subscription process, we're working through technology to try and streamline that process internally. No more paper subscription, PDF stuff. We're trying to do that all through online portal-based subscription, and then investor management tools and things to make the investor experience with us better.
Yeah, sure.
Where you can go through to one point and see what you've got and how it's performing, either on an asset-by-asset basis or as a portfolio.
Okay, similar to what we use with Juniper Square.
Yeah, Juniper Square is definitely a top-of-line candidate. It's very familiar with them.